Edition of InvestTalk. I'm Justin Klein, and we are joined once again by Luke Guerrero. Thanks for being here again, Luke.
Thanks for having me. I'm in full birthday countdown mode now.
When is
15 days?
I forgot. I knew it was
days.
Mid to late
March 19th.
March 19th. Well, what are you going to do? It's your 30th.
I'm going to work because it's a Tuesday.
Good answer. Great answer. Love that answer. As your employer, anyway, right? But anyway, happy early birthday to Luke. And for everyone else out there, thanks for being here. We're excited for this hour with you to answer your finance and investment questions. But before we get to all the details of today's show, we'll take a moment to tease what we've been talking about almost all last week, which is currently underway, the InvestTalk Market Madness Contest. Instead of basketball brackets, we are pitting companies head-to-head in an epic showdown of market prowess. You can join the fun, and you will navigate your way through the market ups and downs, and you will compete for the grand prize of $1,000. It's free to enter, so you can test your skills in this unique competition. We're hoping this will be the inaugural. This is the inaugural one, and we're hoping for it to be something everyone loves every single year. So all you have to do to sign up or to fill out your bracket, just head over to investtalk.com right now. And the deadline is going to be March 17th to submit your predictions. Be sure to download every podcast going forward for more updates and details, and tell your friends about the InvestTalk Market Madness Contest that they can answer for free. Now, with that said, let's talk about I will talk about the market performance today. We're going to run down some show topics as well. But as usual, we're going to hit on our first caller question now.
Hi. What are some ways to find a stock that can grow over a period of time? And when can you predict if that company is going to be firing people or if people are going to be buying it like crazy so I can still make a quick profit? Thank you.
Well, I don't know if you agree with this, Luke, but I think the simple way to know if a company is going to grow over time is if a company has a good, sustainable, durable business. Would you agree with that answer?
Yeah, I think the best predictor of future profitability is certainly current and historical profitability, and not just profits in terms of one-off items, but consistent, sustainable profits. Now, that's part one of the question. The second part was, how do you predict what profits are going to be? Outside of looking at the business, it's impossible. We don't have a crystal ball. And more importantly, the other part of the question, how can you tell if somebody's going to buy a bunch of a company or sell a bunch of a company? We don't know. You can't predict investor behavior. So I think this really just highlights for what seems to be a very young caller to stay disciplined early on in their investing career and not try and chase.
Well, I think it goes back to what most new investors look at the market as. And they look at the market as a way to make a quick buck, in a way, gambling. And a lot of people are in the markets today because of the pandemic, because sports were shut down. They were gambling on sports, and that was kind of their way to potentially make a quick buck. And they realized that, yes, in markets, you can trade, you can make a quick buck if you position correctly, but that is the minority of traders out there. The majority of traders, they lose money, especially if you're in the options market and you're not knowing what you're doing. And so if you're in this, if you're listening to the show, you'll probably know this is not a show about trading. Now, we talk about what the near-term outlook could be for a particular sector, company, etc., but we're more focused on investing, finding good companies, quality businesses, etc., not chasing the latest fad. If that's what you want to do, frankly, there are a lot of kind of faddish shows that are out there that you could probably listen to. And you have to decide whether you want to be a trader or an investor. Investors, over time, they tend to do very well and make money. Traders, only the very, very best, the cream of the crop, actually make money over the long term. So just a heads up there, and hopefully you develop into the former. Now we're going to pivot over to a live call and talk to Chris from Florida, looking at HUN, which is Huntsman. So I thought
Huntsman. Yes, sir.
You own it or looking to buy it?
I own it. I picked it up a while back, probably down like 20% on it or so. Just held it what seemed like a bottom, around 20 or so. And I was just wondering, if you see any sort of reversal or anything trending in the right direction on this one going forward in the next year or so.
Well, I will say the technicals are improving. It hit a low back in late October, early November. And November 1st is when it bottomed. And it has been making a series of higher highs and higher lows. This recent surge on the 22nd of February is starting to consolidate. That is a positive overall. So I will say the technicals are modestly bullish near term. It is above all the major moving averages, etc. But Luke, what are you seeing on the business front here?
On the business front, I'm seeing cash flow falling over the past 5 years. If you take a look at its revenue growth, its 5-year average annualized revenue growth, it's actually negative 8.2%. Their margins have also been slipping over the past 5 years as well. I mean, just from a first glance, it tends to look like a company that's certainly in turmoil. They have $2 billion in debt on a $4.3 billion market cap company, and on top of that, they're incredibly leveraged. Their interest coverage ratio is only a 1.57, so there's not a lot of room for error here. So it certainly makes sense to me that over the past year, this company has certainly fallen.
Yeah, and what you can see with that leverage brings volatility in their profitability. If you take a look at return on equity, it vacillates wildly because their return on assets only hangs on average over the past, say, 10 years, somewhere in the 5% range, but goes as high as 14 and as low as -1. So, that leverage does cut both ways, and I think that's one issue. So I would be looking to get out of it because I like companies that have consistency to their business. And this is a company that's kind of all over the board. It's supposed to only make 60 cents this year versus $3.13 in 2022. So I might hold on to it near term, but I'd be looking for an exit and have probably a tight stop on it at some point in the near future. Thanks for the call. Let's go to Sid in North Carolina looking at Google.
Hi, Justin. Thank you for taking time to receive my call. Yes, I do have Google in my portfolio around 100, 115 price range and less than 1%, of course. But I thought with this recent pullback, is it a good price to add at this price, or do you think we have to wait more? Thank you for your suggestion.
Thanks for the call. Google, I don't think I need to explain what Google does. But I think this is clearly the company with the biggest risk of losing its market position due to the AI craze, large language models being developed and deployed onto many platforms, including Windows and many places now that you can find an alternative outlet to ask your question, to look for data that allows you to kind of escape the Google ecosystem to a degree. And I think that's one of the reasons why the technicals are starting to weaken. It's now right at the 200-day moving average, which is at support, but clearly diverging from the broader market and the Mag 7. Do you agree with that, Luke, or you think Google can pivot and remain a strong player in that space?
I think it could. It certainly could, but I do agree that it's the most vulnerable. If you think about what Google is, it essentially sorts information. Mm-hmm. And the biggest threat to Google is the rise of artificial intelligence and different, more efficient ways to sort information. Now, certainly they make a lot of their money off of ads. That's primarily where their revenue comes from. Mm-hmm. But if you think about what has been driving tech upward, it's cloud computing and efficiency. And where Google is lacking and where Microsoft excels is their ecosystem is tied to hardware. Mm-hmm. Google doesn't produce any hardware of its own that ties to its ecosystem. So I think that makes it uniquely vulnerable to some of these threats of companies coming in and tearing apart what has historically, or at least over the past 20 years, been a pretty stable a data business.
Well, you could argue the Android phone, right? Android platform.
Yeah, you can argue the Android phone, but to me, that's for consumer retail use, whereas Microsoft has business computing. You really can't separate yourself from the Microsoft ecosystem. It is so ubiquitous within the business community in terms of their hardware being used, and that's just not the case for Google.
Yeah, and while I think Google can potentially roll out a competitor to ChatGPT, and they're working, I think they have one, right? What's the name of it? Get the name.
Gemini,
there we go. But yeah, being able to get that in front of enough people, obviously Microsoft launched the the Copilot on Windows. I know Apple is talking about, I've heard rumors that their next WDC, they're going to roll out an AI, basically Siri AI. And I'm sure that's going to cut into the potential search business of Google. And that's the problem here, is that Google, while they can, I think, compete in this space, that would be a bad position to go to from where they're at now, which is a dominant share of search, right? To go from 80-90% of the search market to, right, maybe a third, if they're lucky, of the large language model usage. I think that's a very bad position for Google to potentially be in. And I mean, I think it makes a lot of sense. I know I use it a little bit. I know Luke used ChatGPT a lot. Would you say that it's usurped a lot of your Google searches?
Yeah, no, I absolutely think it has. And one important thing to remember about these types of names broadly is, and I know depending how you decide to sort it, but Google's a tech company, and tech companies are winner take all. It is eat what you kill and capture it and keep it. And so whoever comes up with inertia is a very powerful thing. Whoever can come up with something that works for the most consumers and businesses as quickly as possible is going to win this market.
Yeah, I would agree. The technicals also have rolled over, despite being at kind of a near-term support level. I don't love the divergence from the rest of the market and the other tech names, and that's on the weekly and the daily chart. So this is a name that I would definitely be thinking of at least trimming from your portfolio and most likely eliminating because of those risks. I think it's priced pretty expensively for those risks going forward. Now, we have a lot of ground to cover in the next 45 minutes or so, and our main focus point concerns this topic. Long bonds might be coming back into fashion. Rising interest rates sparked elevated Treasury yields, thus representing a headwind to the price of long-dated bonds. And the question is, are those longer bonds coming back into, are they becoming more attractive? Let's say that. Are Treasury yields being this high an investment opportunity? Well, we'll talk about that. We're also going to discuss some other topics as well. One is in regards to, have you ever bought or thought about buying a second home in another state, potentially to avoid taxes? Well, it's not as simple as just buying that home. There are some ways that you can assure that your current state isn't successful in potentially preventing that, potentially challenging that move. So we'll talk about that. Also, AI has sparked another round of convertible bond issuance. A lot of people talk about convertible bonds, and they can cut both ways. So we're going to talk about that subsector of the bond market. And then lastly, if we have time, is your 401k destroying capitalism? We're going to talk about some trends and how that might be impacting the broader markets. Now, we're going into a short break. On the other side, we'll talk about today's market activity. But remember, you can call anytime and leave your question on the InvestTalk voice bank at 888-99-CHART.
For investors, the goal of achieving financial freedom requires unbiased information, strategic planning, and determination. Congratulations! You've found the podcast that is dedicated to helping you succeed. InvestTalk.
Now let's take a look at the market performance for today, Luke. It was kind of a mixed bag. Looks like large cap stocks down about 0.1%. Small cap stocks up 0.01%. Mid caps did the best, up nearly 0.5%. That was the strong part of the market. Very interesting. You had some big movers. New York City community bank shares once again falling out of bed, down 23%. Tesla down 7%. You had Marathon Digital, despite Bitcoin's price going up, that was down 5%. NIO, the EV company out of China, that was down nearly 8%. So certainly some big movers. Pfizer down 2.5%, Ford Motors up 2.3%, Apple down 2.5%, and American Airlines down 5%. So I saw more big movers down that were larger companies than up. That's for sure. So pretty interesting day as we head into tomorrow when we get the ISM Services index, PMI index, and that will be very interesting to see where prices are and where economic activity lies. What were you seeing in the markets today?
Well, I saw pretty much what you saw. I didn't see really any big directional drivers as to why there were big moves. I know that SMCI was up a lot on news that it was going into the S&P 500. Decker was up pretty decently midday. But generally, I think the market's just waiting for, like you mentioned, ISM Services on Tuesday, private payrolls and JOLTS on Wednesday, and an employment report on Friday, as well as Chair Powell, who's set to appear before Congress this week. I know that's always a fun time to watch market volatility as he's speaking.
Yeah, I think that's so funny. Now you add SMCI to the S&P?
I have been saying for a very long time that the construction of the S&P 500 is nonsensical. It's a committee that decides what goes in when, and it's just an
active,
index by committee.
It is active, right? It's an active.
It is passively actively managing. Yes,
exactly. Like, yes, once the allocation is set, then it's passive. But then they go and change the allocation. It's active. It's just the committee that decides what random 500 names of the top. What do you think their universe is? 3,000, 2,000 top names? Because it's not the 500 largest names in the market, right?
No, they probably just use a total market cap approach where they say any company is eligible above X amount, and then they just draw straws. I don't know. It's up to the committee.
And that's the thing. We don't know. Nobody knows really their protocol. So that's pretty funny. One other news on the day was gold. Gold had a big day on Friday and another follow through day today. And gold had been consolidating for really the entire fall and winter so far. And it's just starting to break out to multi-year highs now. So very interesting turn of events. Usually that happens when economic data is weakening. I think we're going to get some more data tomorrow, but very interesting to see gold break out after a multi-month consolidation phase. Now let's dip into the InvestTalk voice bank for a listener question that came in earlier. You know the number, it's 888-99-CHART.
Hi there, this is Joe calling from Nashville. I wanted to get your take on Murphy USA, ticker symbol MUSA, operate a large national chain of gas stations, convenience stores. I use the company a lot, which is why I'm interested. But as I'm looking at their chart, it looks like it's never cheap. So I wanted to get your take on the company and see what a good entry point may be. Thank you so much, as always, for your help.
Well, I'm not sure what he means by it's never cheap. Saying you're looking at the chart and it's never cheap. Is he just saying, oh, because it trades at $420 per share, that's expensive? I hope that's not what he means. Think that's what he means, Luke?
It could be what he means because from a price to earnings perspective, it's about where it's been 15 times. And price to sales, it's about 0.4, which is where it has been historically. It looks a little overvalued to me if you look at its price to book, 10.5 relative to its 5-year average of 6.3. But something happened in 2022 and their revenue grew from 17 billion to 22 or to 23. And that's pretty impressive. I don't know what happened there.
Yeah, well, for everyone else, Murphy USA is an American retail retailer of gasolines and convenience store merchandise throughout the United States. Stores are 100% company owned, and most of them are next to Walmart stores. I've definitely been to one or two, more like in the desert. So these are in more rural areas. So maybe it's, hey, people are moving out into rural areas and thus more customers for them. That could be could potentially be what's causing it. Its position in markets is low price, high volume fuel retailers selling through low cost kiosks and small stores. So it's pretty interesting to see this move, and earnings have moved with it. Pre-pandemic, they're only making $4.89, 2019. This year, it's supposed to make $26.60. And like you said, maybe a little overbought, a little overvalued, but not dramatically so. And it looks like they're sustaining this level of profitability. So I have no problem buying this. Probably want to wait for a little bit of a pullback to get into more reasonable valuations. I would say if it gets into $330 to $350 range, that's probably where I'd pick it up. Now it's at $420. Thanks for the call. Now, on the next Invest Talk, we'll look into this topic: how to use gold in your portfolio. That's tomorrow. But for now, I'm Justin Klein with Luke Guerrero, and we are ready to take your calls at 888-99-CHART. Invest Talk Market Madness contest, and here is how it works. Instead of basketball brackets, we're pitting companies head-to-head in an epic showdown of market prowess, and participants will navigate through the market's ups and downs, all competing for the grand prize of $1,000. So make sure you head over to investtalk.com, download your brackets, fill them out, and then complete it using the link on our site and secure your chance. And a lot of people are asking, since we are entering a Fed easing phase, whether or not now it's time to get back into the long bond trade, because typically the 10-year yield peaks and then trends lower in advance of rate cuts becoming official. Now, they've kind of teased when rate cuts will be. We don't know exactly, but your assumption would be that the 10-year would be trending down, and it has really since the Fed announced that they will be cutting rates this year, last fall. But you're starting to see rates perk up back again. The 10-year did go from a low of around 3.8 or so, all the way up to the recent high of about 4.35 on the 10-year. Now we're back down to about 4.2. But historically, Luke, 4.2 is pretty juicy. Should investors be locking in that rate for an extended period of time?
4.2 is super juicy, but I do think that reversal in the 10-year yield was as a result of a lot of market participants thinking rates would be cut in January and then thinking again they would be cut in March, and now acquiescing to the fact that it's going to be probably similar to what the dot plot shows in terms of the number of cuts, and the timing will be more delayed than some expected. But to that point, if you believe the Fed, which we probably should believe the Fed, they're the ones who are changing the policy rate, then they have alluded to the fact that this is about as high as rates are going to go. So regardless of when the cut is, this is the peak. What you don't want to happen is lock in low rates and then rates go up. But it doesn't seem to me as though that's going to happen. So if there ever was a time to reach further on the yield curve, it's coming up.
Yeah, I would agree with that to a degree, because I think it's clear with what you're seeing now is, yeah, the Fed wants to cut rates or set up the market to cut rates. But, inflation, while down dramatically from its high, is still, kind of around the 3% range, depending on what measure you look at, which isn't 2%, which is their goal, right? And that's why they talk about higher for longer, and why the market priced in 6 or 7 rate cuts after that announcement in the fall. And that's slowly gone back to, like you said, the dot plot, which is about 3 rate cuts on the year. I actually think the market's still pricing in roughly 4. So there's still some room, I think, for that to come down. And if we are in an inflationary environment, yes, the Fed might go on a rate cutting cycle, but it's likely not back to zero, right? Might go from a Fed funds rate at 5.25 now to only maybe 4.25, and then the next high is even higher than it is now, right? The next rate hiking cycle. And so I think there is that risk that it is a very short long duration trade, right? Meaning, hey, yeah, you long duration's okay probably for the next 12, 18, 24 months potentially. But from there, it's likely to not be a good trade over, a 5 to 10 year time horizon. And so that's why I say 2022 is probably more of the norm. Maybe not that much of a sell-off in bonds, not that much of a rise in rates, but the general trend, at least if you look at a longer-term chart, is higher. And so I think it's still a trade. It's not hey, let's term out all of the bonds in our portfolio. In fact, for our clients, we're kind of sticking in the 3 to 4 year range for new issues, which I think is kind of the sweet spot where you're locking in pretty good yields for a decent amount of time, but not exposing yourself to too much duration to where if, the inflation does reaccelerate, that you get another large sell-off in bonds. So I think the answer is yes and no. That makes sense?
Makes sense to me.
All right. Now, from time to time, we receive InvestTalk questions via email. In fact, this is from a client that wanted to know about American Express, wanted me to answer it on air. And American Express, I don't think I need to tell everyone what American Express does, but this is a name that's been on a tear recently, Luke, from a 141 or so back in the fall all the way up to $218 per share. And we know that you recently had the acquisition of Discover by Capital One, and they're trying to, I think, create an American Express, maybe on the low end, right? American Express typically caters to the high end consumer, high income. They have Amex, Platinum, and all of that, and that whole incentive program there and perk program. So, do you think that Capital One could edge into Amex's space as being a processor of credit cards as well as having that loyalty program?
Well, I think that is the big reason behind it. Why Capital One decided to buy Discover is because they did want to edge into the payment clearing that Visa and MasterCard have really had a stranglehold on for some time. Mm-hmm. And also, I do think that it's going to allow their consumers to have a more robust rewards program. But like you said, I think that the clientele of Capital One versus Amex are kind of different. And the niche market that fits the Amex Platinum and the Amex user is one who travels a lot consistently. And frankly, I have the Amex, and their rewards are mostly beneficial to people who want to travel internationally. So I don't see Capital One and Discover, should the merger go through, who knows, with the FTC and the DOJ these days, should the merger go through, I don't really see them picking at the heels of Amex because it seems to me like it's a niche user base.
Mm-hmm. So maybe more at the heels of Amex or MasterCard and Visa than anything else.
Yes, correct.
Yeah.
But also it's a good thing, right? We like competition. They've had a stranglehold for so long. We should encourage this.
For sure. Now, American Express itself is a very good business, very minimal debt. They certainly can raise their dividend, which is only 1%, but their payout ratio is only 21%, so there's definitely room there. But it's a cyclical business. So if you have the economy weaken, you have to account for that. And I think this rally is the market kind of saying, hey, there isn't going to be a hard landing. It's a soft landing. And so there's risk to that. And I do think it's a bit expensive at these levels. Would you agree with that, Luke?
It's a bit expensive, but it's not crazy expensive. It's about 10% over its 5-year average price to book. It definitely does seem expensive to me. One thing I would also point out that you didn't mention is they've consistently bought back shares over the past 5 years. From 2019 to 2023, their shares outstanding dropped from 850 million to about 700 million. So that's certainly nothing to shake a stick at there. So that's another benefit to shareholders who have invested in American Express.
Yeah, a buy point on this would be somewhere on the 180 level. Now it's at 218. So overbought, and this we're going to get a last summer like pullback. Right, last summer we had the pullback about 10-12% in equities. You're probably going to get that sometime, I would imagine, middle of the year, and that would be a time that maybe you want to pick up Amex, but not today after this recent run. Now let's keep things moving and play another InvestTalk caller question from our 24/7 voice bank at 888-99-CHART.
Hey, Stephen Luke, calling about Palo Alto Networks, ticker PANW. I wanted to get your thoughts on if this would be a good entry point after this somewhat of a pullback, and Pelosi bought it as well. They just received a government contract, so wanted to get your opinion if this would be a good entry point, or you think I should wait a little. Love what you guys do. Thanks a lot.
All right, Palo Alto Networks did have earnings that were certainly disappointing. It pulled back from about $360 per share all the way to $260 per share. So quite the drop. Now it's rebound to right around 300. But Luke, their sales and earnings growth are certainly slowing. And in a name valued this richly, do you really want to tie yourself at these particular prices after this major reversal? I think this wants to head lower in my book.
I agree. I think the primary driver of why it headed lower wasn't its historical results, but its forward-looking guidance, in which they said they were going to have some trouble in customer acquisition and in terms of revenue going forward. And I think I would tend to believe them when they say that. It's still trading at a forward-looking price to earnings of 51, which is incredibly expensive. Its price to sales is at 15. So to me, this still seems a little too rich. I know it had a recent drop-off, but I wouldn't enter at this point.
Especially incredibly expensive when you consider this year's earnings are supposed to drop 7% from last year, and next year only go back up 11%. So you're talking about from last year's earnings of 444 to next year's earnings of 462. That's pretty low growth. Are you going to pay 50 plus times for that level of growth? I'm not. I want this to be at least 30, 40% lower. So you're talking 200 or so before I even start thinking about this. Thanks for the call. Now, the first quarter feels like it's moving pretty fast despite the fact that we had an extra day with Leap Day. We are now into March, and the market is at an interesting place. You're certainly seeing peak euphoria in parts of the market, and the question is your portfolio uniquely exposed to that peak euphoria? Maybe in a good way, maybe in a bad way. Well, only one way to find out, and that is by scheduling a free portfolio review assessment with myself or Luke at our company KP Financial, where we practice parallel investing, which means we invest right alongside our clients, and we operate the same philosophy as we do here, which is independent thinking and shared success. So I encourage you to take advantage of these free portfolio review assessments via telephone or go-to meetings by heading over to investtalk.com. Let's go talk to Sammy in San Francisco. Wants to talk about everyone's favorite stock, NVIDIA.
Hi, Justin. Thanks for taking my call.
Sure.
As you all already know that this stock has taken off, right, like no one else in the near term, in the near past. And I've been investing in NVIDIA. I've actually bought several of those. I did several of those transactions a couple of years ago, and those have done really well. I am kind of watching to see if there is going to be a pullback so I can move more capital in. Mm-hmm. So do you suggest I wait until a pullback appears, or you think this thing is just going to continue to skyrocket and there's no point wasting time?
Well, I think that it's either going to continue higher in the near term or it's going to reverse massively. So I don't think there's a quote-unquote pullback. I mean, you got a mini pullback before earnings into the 20-day moving average, and then earnings were pretty good, and it's been consolidated that move for about a week, and it's moved up the last couple of days. Now, I will say today was mildly bearish because it closed in the bottom third of the trading range for the day, and it had pretty high volume. Now, it wasn't clear-cut, but I do say we're getting very close to a top in NVIDIA, and I think there's strong parallels between NVIDIA and Cisco in 1999 when everyone was extrapolating the recent growth into the future. And so NVIDIA is going to have to really maintain 100, 200 plus revenue and earnings growth for a number of years to make these valuations worthwhile. And if it doesn't, it's certainly going to drop dramatically, And when typically these names, they drop 70, 80% from their high. So if you do get that major reversal, it's going to be large. So just a heads up there. But I wouldn't short it here. But going long, it's going to have to hold this 20-day moving average. If it doesn't, then it's going to have a massive reversal. There's no pullback really that you could say it's a buying opportunity at these levels. It's going to have to get sentiment completely the other way for you to really have a good buying opportunity here. That's my take. Do you have anything to add, Luke?
I generally agree. I think when people talk about the AI craze, NVIDIA is the one company that has certainly been putting its money where its mouth is in terms of its sales growth and its revenue growth, its earnings growth. But to that point, there isn't a lot of competition that has the advanced chips that they have. And anytime there is an incredibly lucrative market, competitors will come in. This isn't, like I said before, building airplanes. This isn't something that is incredibly capital intensive. So people are going to be trying to nip at their heels. But for now, I do agree with you that this doesn't seem like the type of company or the type of chart technically that is going to flatten out for a little bit and have a minor pullback. It's either going to just continue up or it's going to pull back massively.
Yeah, it's going to grind higher, or you'll have that. It was what's happening right now is called a gamma squeeze. There's a lot of speculators in the name buying call options, and gamma squeezes are reflexive, meaning the more it goes up, the more people jump in with options that are profitable. They buy more options, and the gamma squeeze just keeps going and going until the reversal happens due to some catalyst, and all that gamma squeeze starts to unwind dramatically. So that'll happen eventually. It's just a matter of what is the timing there. And as Luke said, someone's going to come in. Look, Intel is trying to come after their market share. This is the history of technology. Everyone's trying to come after their share, and eventually someone likely will outcompete them. That was InvestTalk. I'm Justin Klein. We're going into a break, so give me a call at 888-99-CHART.
In today's market, more than ever, you need unbiased investing guidance because it can help you achieve financial freedom. Well, you've come to the right place. InvestTalk, 888-99-CHART.
Hi, this is Duncan. Always a big fan of your podcast, and just giving a quick call because I am looking into stock ticker TSN, Tyson Foods. The reason why I bought this about last year was for the dividend, and I actually see that it's not performing so well. The fundamentals actually say that it's negative in return on equity and return on assets. So I'd like to know your 2 cents. This is actually in my Roth IRA. Thank you very much, and have a great day. Bye.
Are looking at Tyson Foods. Most people know what they do. The producer of beef, chicken, pork, and related products. And this is a stock that hit a high nearly $100 per share back in 2022, early 2022. But the recent 52-week low was only at $44.94. Now we're at 53 and change. And that's all because their earnings took a pretty big dive. They made $8.72 in 2022 with only $1.34 last year. So let's make $2.25 this year and $3.55 next year, which is a nice rebound. But not back to pre-pandemic levels. Is this just simply the costs of labor going up here? I'm trying to figure out what's shrinking their profit margins so much. Are you seeing anything, Luke?
No, but I will add to that it's shrunk enough that they had a string of slaughterhouse closures, mass layoffs. I mean, things seem to be pretty dire at the company. They're running at an interest rate coverage ratio of 1.67 because they're $10 billion in debt on an $18 billion market cap company, and revenue is falling. Yeah. Profits are falling. So it seems to me that all signs point to a company in distress. Cash flow's down, profitability's down.
Yeah, I will say this, though, at least based on the last quarter, fourth quarter, that maybe the worst is behind them. You had operating cash flow trailing 12 months go from 1.75 billion to 2.3 billion. So obviously the previous quarter was pretty good. Free cash flow as well went from negative territory up to 586 million trailing 12 months. So this last quarter, there was a lot of headway in right-sizing their business. And, it's typically a business that does, even if you take out the pandemic era, it was running between 1.5 to 2 billion of free cash flow for a number of years before then. So, maybe it seems like it is a reasonable bet, like as you said at the top of the show, that profits tend to be mean reverting, especially in a business like this. It's not like people are stopping eating chicken and beef and pork. I don't think those trends are changing. So I think it's a decent flyer on a name whose technicals are improving just a bit.
It could be. I think that something that does tend to happen, especially when growth is driven exogenously, right? If you look at in 1970 or 1960, we were killing about 1.5 million chickens a year. Now it's about 9.5 billion chickens a year. Sorry, 1.5 billion to 9.5 billion. The average American eats 68 pounds of chicken each year today. So when you tend to have that growth exogenous to your company, you can get lazy and start to expand beyond what you need to expand and have a lot of things at the periphery that drag down your profit margins. That could certainly be the case here. So right-sizing the company could be beneficial towards long-term profitability.
Yeah, I agree. I think it's a reasonable bet. It's not going to knock your socks off, and I don't think it's going back to 100 anytime soon, but could this get back into the 70s as long as they continue to make progress towards reasonable profitability? I think it's not bad. Thanks for the call. Do we have time for one last one? Let's talk a bit about convertible bonds. Convertible bonds are back in favor, especially SMCI. They just issued $1.5 billion of convertible bonds. And this harkens back to the era of 2020 and 2021 when Peloton and Beyond Meat were issuing these type of securities. So is this a sign that maybe things are near their nadir or their high?
I think that companies and corporate finance directors will always take advantage of a market that allows them to borrow money for cheaper, and convertible bonds is a good way of doing that because you can incentivize, or you can allow somebody to convert it to equity if they hit certain targets and therefore offer lower yields. So long as a company's stock price is rising like SMCI's has, they're certainly going to take advantage of it, and I can't fault them.
Yeah, especially when you can say, oh, yeah, I'll issue shares at a much higher price than we're seeing today. That's basically what convertible bonds can eventually do, or maybe the buyer just gets no interest at all, which is what's happening now with SMCI. So very interesting to see that trend back in place. Now I'm Justin Klein with Luke Guerrero, and this completes another InvestTalk program. We thank you for listening. We encourage you to tell your friends and family about our free podcast downloads, which you can find anytime at iTunes, Spotify, or Google Play. And be sure to rate and review on iTunes as well. And it's official, we have now surpassed 58 million podcast downloads since it all began, and we thank you for that. Independent thinking, shared success. This is InvestTalk. Good night.
InvestTalk is a trademark of KPP Financial. Because of the nature of the interactive dialogue inherent in the format of this program, it's important for the listener to understand that not all comments made will apply to them. Specifically, nothing said shall be taken to be investment advice, or shall statements on this program be considered an offer to buy or sell security. Because such advice is rendered solely on an individual basis and at times will require that the investor review a prospectus before investing. InvestTalk is a copyrighted program of Klein, Pavlis, and Peasley Financial, a registered investment advisor firm which retains all rights. For more information regarding KPP's investment advisors, call 1-800-557-5461.